Hello, very good morning to all, and welcome to today's Daily Dose of Market Insights. I'm Kelvin here again. Very good morning. Today will be Wednesday, the 17th of July, 2024. So before we start our Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so before we jump straight into our short-term intraday technical outlook on the major cross assets ranging from the key US dollar major pairs, the major stock indices, and as well as two major commodities, that is i.e. XAU/USD, gold, and West Texas crude oil, WTI. Let's have a quick recap what has taken shape yesterday in terms of news flow, economic data release, and as well as their respective impact on the price action of the major cross assets. Now, let us start with the key economic data releases first for yesterday. All right, so yesterday we do have one key economic data release, which is the US market, all right, over here, okay, relating to retail sales. So why retail sales is important? Because retail sales consists of part of the services sector in the US that contribute close to 3/4 of their we call it contribution towards US economic growth. And do not forget, yesterday in my daily dose of market insight, I did highlight that over here is that there are actually leading economic indicators that are kind of a proxy to retail spending or consumer spending in the US that has started to turn soft, which is the contractionary reading of the US ISM services PMI that was released about 2 weeks ago, that actually strengthened to a negative territory below 50, the level mark. And also last week, we do have a lackluster, last Friday, I would say, we have lackluster consumer confidence data that's been compiled by the University of Michigan that continue to slip for 4 consecutive months in the month of July based on their preliminary readings. And it did turn out that the retail sales numbers also did not actually expand as great. Why? Because you look at the month-on-month retail sales is almost flat at 0%. It went down by 3 basis point from 0.3% that was actually printed in the month of May. And if you look at for a longer term, managing of the cyclical or seasonal impact is on a year-on-year basis. So on a year-on-year basis, it also continue to actually track down much lower compared to the previous month of 2.6% year-on-year in the month of May. So it went down to 2.3% in June. So if you look at the longer term trend on a year-on-year basis for retail sales, all right, okay, give me a minute to load up. Yeah, so it's also kind of the growth also tend to decelerate. The current year-to-date high of 3.6% year-on-year that was printed in March this year. So after that 3.6%, you see 3 consecutive months of growth deceleration. So that's actually in line with our expectation, where we highlighted that I highlighted that softness in the leading economic indicator, that means i.e. the services PMI data, the University of Michigan consumer confidence data, that all started to turn soft. So that actually being reflected on the lagging indicator, which is retail sales, is kind of lag behind. Softness as well in retail sales that was being expressed yesterday. So with this softness in the retail sales that's being expressed, or I would say that being shown yesterday, it actually allows market participants to actually have much more confidence that the US Federal Reserve will start to cut interest rate in September, and potentially there could be another 2 more interest rate cut in November before 2024 ends. That means 1 more in the month of November and another one in the month of December. All right, so very quickly, if you look at the CME Fed Watch 2 over here, the Dow hasn't really changed much. after the release of yesterday's lackluster, I would say that retail sales number that is coming out from the US. All right, so what we could see over here very quickly. Okay, this is the CME Fed Watch 2. So immediately I'll jump straight to the probability where it tells us a combined probability. Okay, so it's easier to actually innovate. Okay, so far for this month of July, market is based on the CME Fed Watch 2. This CME Fed Watch 2, I repeat again, is actually based on a calculation on the Fed funds interest rate futures pricing. All right, so it's being inferred by the futures market of the Fed funds interest rate. So put it away that it's a short-term interest rate futures instrument where market participants are placing some bets going forward, and these bets can be calculated like a probability whether the Fed will actually hike or is or no change in the upcoming FOMC meeting. Okay, so based on the current odds right now, the chances are very high that in the end of this month, which is the upcoming FOMC meeting in 31st of July, the Fed will actually stand pat at 5.25% and 5.5%. So that's 93% chance, very high. Only a small percentage of market participants, based on their bets that are being placed on the Fed funds interest rate futures market, only expecting 70% chance the Fed will move on to hike by 25 basis points. And the higher probability still remains unchanged since 2 weeks ago at 93%. The market participants in the Fed funds interest rate future market is expecting a high chance of 93% that the Fed will move only in September by cutting its first 25 basis point to bring it down to 5% to 5.25%. And previously, there was actually very low odds of another cut to be enacted in November. But after Fed Chair Powell rather dovish tilts public speech on Monday, it actually increases to 71%, a very high chance. This is above 50%. So market participants expect the Fed right now to actually have a more clear sign of starting a interest rate cut cycle rather than a first cut, then they pause for a couple of meetings before deciding what to do next. So it's a very clear sign now. Market is now looking for the start of a interest rate cut cycle. All right. So I could see is that a chance of 71%, another 25 basis point cut in November, and also a high chance of 59% right now, 59% for another cut before the year ends to bring it down to 4.5%. So overall, market now is expecting 325 basis point cut in the month of September, November, and December. All right, and also very aggressively, there's another chance to come in March right now. So because of these 3 cuts that's being front loaded in 2024, market now do not expect the Fed to move again in January. Okay, January was stand pat at 36%. Okay, very low odds, only 36% chance, all right, of actually putting another 25 basis point cut. And the first cut of 2025 will come in the March meeting, which gives us a very high of 83%. Then thereafter, another cut again on the April meeting. Okay, so it seems to us that right now market is still looking out for a rather dovish Fed, a change of stance earlier at the first half of this year, or even somewhere around the previous meeting in June, where the Fed stance is actually keeping interest rate for a higher level for a longer period of time as they assess for more data to justify the first interest rate cut. So right now, very clearly, data right now is in favor for the Fed to actually cut rates because they keep hampering of them being market dependent. And if this time around they choose not to cut rates in September, that means it actually will, the Fed will actually starts to lose credibility to market participants because, hey, you keep telling us that you are data dependent, and right now the data is actually favoring for a interest rate cut instead. All right. Okay, so now with that, right, that actually this particular rather lackluster retail sales data doesn't change the dial of market expecting of a change of the Fed stance to much more dovish right now, continue to support the risk-on behavior in the US stock market. So if you look at the US stock market yesterday, all of them actually closed in the green. All right, but I want to highlight over here is that previously, for those who joined our daily dose of market insights since last week, I've been highlighting there is a high possibility that the laggards will do a catch up, and the laggard indeed actually catch up since the start of last Friday, where the Dow Jones Industrial Average yesterday and the Russell 2000, which is these are the two laggards, okay, among the major US stock indices since the start of this year, because this Dow Jones and the Russell 2000 are very less weighted by the mega cap technology stocks, and they do not have any high component stocks that are related to AI. So given that the fact that the Fed now has started to turn more dovish, lower interest rate, they actually benefit the stocks, as well as some of the financial stocks that are actually heavily weighted inside the Dow Jones and the Russell 2000. And the Russell 2000 is much more related to small cap company that has a lot of debt burden in their balance sheet, and this debt in their balance sheet are actually more or less heavily weighted towards short-term floating rates. And given that the Feds are about to cut rates, their debt burden will lower. Because why? Because all their debt are actually being geared towards not long-term interest rate, because they cannot negotiate a higher the long-term debt to the banks or in terms of raised bonds because of their lower credit rating. They got to rely on we call it a credit facility term. And given that these shorter term credit facility terms are being tied on the Fed funds rate, and with the Fed funds rate potentially coming lower, it will actually reduce the debt burden of this Russell 2000 company. So this actually explains to us why the Russell 2000 has been very bullish in the last 3 to 4 sessions. So yesterday it's up 3.5%, the Dow Jones Industrial Average is up 1.85%, the Nasdaq almost unchanged at 0.06%, and the S&P at 0.64%. So what I could see over here is a healthy rotation into the laggards rather than the start of a 20% corrective move. So later I'll share with you why again as well by looking at the intermarket dynamics of things. All right, and one more news flow I want to highlight over here is that over here is IMF. So very interestingly, right now IMF seeing what's IMF yesterday, occasionally they will come out their so-called special research report on the global economy by having a dissect of where economic growth would be for the major economy, and as well as any global threats that they actually, or global, we call it red herrings, that they see in their reports. So yesterday, what they did over here, they released their report, the latest update report on the global economy, saying that 2025 growth estimate rise to 3.3% to 3.2%. Okay, so this for next year. All right, so this year it stays the same over here, but he did warn that slower disinflationary risk, higher rates for even longer. So the IMF right now seems to be very conservative against what the US Federal Reserve officials are actually banging on, especially coming from Fed Chair Powell public speech on Monday, where he said that recent data add somehow to confidence that the US inflationary trend is actually inching much lower towards their 2% growth target. All right, so now there's actually a dissynchronization between what IMF is seeing and what the US Federal Reserve officials are looking at. But nevertheless, market participants are paying much more close attention to the US Federal Reserve official remarks, especially Fed Chair Powell remark, rather than IMF warning yesterday. Okay, it's being expressed by the US major stock indices. Market continue to rally despite the fact that IMF warning that interest rate may stay longer for a higher period of time. Okay, so later I'll touch on more about this intermarket dynamics. Okay, how do we look at things that whether interest rate will stay higher for a longer period of time is looking at some form of market transacted based contract. That's where we can infer inflation expectation, taking into some correlation with other traded commodities market as well. Right. So with that sum up the key economic data and news flow that has taken shape yesterday, the key ones that I want to highlight for you all. And right now we will jump straight to the fundamental and as well as the medium-term intermarket dynamics at play. All right, so the first intermarket dynamics on share belt is related to this IMF warning for a possibility of higher rates for longer period of time, is by looking at this particular chart over here. All right, where I try to plot over here is these three charts. Okay, in fact, there's still three lines, 1, 2, 3, 4, 5. Okay, firstly, on the constraint to your is the WTI crude oil, which is the crude oil prices, which is in green, like green, turquoise green over here, followed by this dark blue line and light blue line with the US 5-year break-even inflation and the US 10-year break-even inflation. So this break-even inflation, right, think of it as a 5-year inflation expectation and a 10-year inflation expectation as being inferred by market participant on the US Treasury inflation protection bonds contract. Right, it's based on market transacted pricing. So what's interesting over here is that you look at both the 5-year and the 10-year break-even inflation has been inching much downwards since early April this year. All right, and the inching downwards right now is actually also hitting very close to the the Federal Reserve official target of 2%. Why? Because the 5-year now is trading at 2.2%. The 10-year now is almost the same as 2.26%. So inflation expectation in US has started to come down. All right, and the reason why inflation expectations start to come down because oil prices can't break above the $91 mark that was printed was September last year. So far, it hit a high of $87 per barrel in 1st April. Then thereafter, it tried to trade sideways. So as long as oil prices continues to remain below the $91 mark / $87 mark over here, inflation expectation shouldn't be anchoring up on the upside as well, but rather they should actually slowly trend downwards around the 2% target towards the Fed target. So i.e. right, in order for then that actually also express, given that inflation expectation is coming down, the longer term interest rate by taking into account this purple line, which is the US 10-year Treasury yield. So look at the way that the US 10-year Treasury yield as a proxy of long-term risk-free interest rate. Why? Because the US government is considered as a government that oblige their debt. We call it a payment, and the US economy is still the #1 economy in the entire world, and the dollar is still being used as a major reserve currency in terms of international trade and settlement. All right, so that's why we look at the US 10-year Treasury yield, which is a government bond yield, as a benchmark for long-term risk-free interest rate. So this long-term risk-free interest rate right now is also inching downwards, okay, from previously a high of 3 point, okay, over here. Okay, let me put it over here so you guys see, okay. So from previously in April, we have a high of 4.62%. Now it actually drift down to 4.16%. All right. So net overall, you realize that the inflation expectation is moving downwards. Why? Because oil price is start to trade sideways, can't go above the $87 and $91 per barrel mark. And because of the softening of this inflation expectation, if this continues to actually play out, longer term interest rate will also continue to inch downwards as well, as expressed by the US 10-year Treasury yield. So net overall, right, in order to tell us that whether long-term interest rate will stay higher for a longer period of time, we need to monitor the movement of WTI crude oil as one of the catalysts. So if WTI crude oil continues to remain in a sideways fashion, not breaking above 87/$91 per barrel, that could actually reduce inflation expectation being shooting up on the upside. Rather, they continue to actually trade downwards towards the 2% level, where this is what the Federal Reserve official wants. Then long-term interest rate will not be able to stay higher for a longer period of time. So that actually explained to us why market is ignoring IMF warning yesterday. Most market participants rather look at what is happening based on market transacted instrument, which is actually playing out right in front of our eyes right now. All right, but nevertheless, oil price is very volatile. If oil price starts to shoot up and break above 87, then this is where the concern starts to come into play. All right, so right now it's not showing up at this point in time. Okay, so that's for the intermarket dynamics of how I look at things to gauge whether interest rate will stay higher for a longer period of time by looking at the intermarket play between WTI price, its impact on inflation expectation by the break-even rates, the 5-year and 10-year break-even rate, and this 5-year 10-year break-even rate, how does it impact the longer-term interest rate, which is the US 10-year Treasury yield, right? So I hope that I try to explain as clear as possible how this intermarket dynamics is playing out. Okay, now with this intermarket dynamics, let me touch on the intermarket dynamics of the US stock market. So the US stock market intermarket dynamics, the breadth is still healthy. Why? Because if you look at the percent of number of S&P 500 stocks that are trading above the 20-day and the trading above their 50-day moving average by these two lines here at the bottom of my screen, the turquoise blue line and the turquoise green line, all of them are inching much higher since since a very lackluster reading that was actually printed in early July this year. But at that point in time, I did mention that, yeah, even though it's below 50%, it shouldn't be a concern. Why? Because it's tried to trade a series of higher low, which turned out that the market breadth continued to actually improve in the S&P 500. That means right now, S&P 500 stocks, more stocks are actually joining the bandwagon that has been taken shape earlier on at the start of this year towards Q1 and Q2 that has been previously leading by just only a small group. That means about 7 or 8 stocks that are heavily weighted towards the mega cap technology stocks that concentrated in the AI gameplay. Right. So right now more stocks are enjoying the fruits of positive momentum. Put it this way. All right. So yesterday we have an increase of of number of stocks that are trading above their 20-day moving average in the S&P 500 jumped to 84%, and then the percentage of stocks that are trading above the 50-day moving average inside the S&P 500 has also jumped to 76% yesterday. Okay, so it's pretty healthy breadth. And despite that, the fact that the Nasdaq 100 closed almost unchanged yesterday, but the percent of Nasdaq 100 stocks that are trading above the 20-day MA continues to inch up higher as well. So yesterday, it actually recorded a healthy number of 75%, and the percentage of Nasdaq 100 stocks that are trading above the 50-day MA also jumped to 74% yesterday, despite the fact that the Nasdaq 100 closed almost unchanged. And the reason why the Nasdaq 100 closed almost unchanged because of the underperformance of the mega cap technology stocks yesterday. Why? Because don't forget, Nasdaq 100, yes, there are 100 stocks inside Nasdaq 100, but majority of the Nasdaq 100 is market cap weighted. That means it primarily dependent on the price performance on the 3 to 4 stocks that are the mega cap technology stocks. That means talk about Nvidia, Apple, Microsoft, Google, which is Alphabet, and as well as Facebook. So if you look at the heat map of the S&P 500 over here, this could explain a very much picture where the market breadth has started to spread to the rest of the other market, which is positive. Consumer, industrial, consumer cyclical, healthcare, real estate, utilities, and even the banking stocks. So yesterday, underperformance was concentrated only in the mega cap technology stocks like Google, Meta, Microsoft, and Nvidia. So Apple, small gain of positive 0.18%. Amazon, a small gain of positive 0.16%, and Tesla continued to improve 1.55%. I believe this is more politically driven because the owner of Tesla, which is Elon Musk, or the CEO of Tesla, Elon Musk, starts to publicly fully endorse Trump as the US president. And given that market participants now are looking for a favor of Trump returning back to the White House based on the betting markets, and given the fact that if Elon Musk is managed to get the good books of Trump, potentially he could be, it's political related. Okay, so I could just stop here for now. Okay, I don't want to dive into the conspiracy of it. Okay, so this is the intermarket relationship by the market breadth, and another intermarket relationship on the S&P 500 I want to share with you all is taking into account of this value play as well that is picking up steam over here. So we start to see that over here is that there is this bull steepening. So this I highlighted since the start of this week, so I don't want to explain what is this bull steepening about again. So for those who actually miss this bull steepening, we call it yield curve, please take a look at my the dados in YouTube over here in OANDA Asia Pacific YouTube channel. Just click on the Intermarket Dynamics tab where I participate it. I explain what is this bull steepening very clearly what it's about. So this bull steepening of the US Treasury curve continue to play out as this purple line going to steep upwards, and the key level to actually watch out for is the negative 0.08%. A breakout of this level will further reaffirm this bull steepening play that is taking shape in the US Treasury yield curve. And this bull steepening taking shape in the US Treasury yield curve is very important for the US stock market, especially the value factor. Why? Because the previous bull steepening of the US Treasury yield curve that took shape in August 2020 all the way up to March 2021 managed to see the S&P value factor ETF outperforming the S&P normal ETF. That means value stocks has starts to outperform, but whereas momentum stocks has underperformed. All right. So the current momentum stocks over here is actually highly concentrated on the mega cap stocks. So with this bull steepening taking shape, we finally see an uptick in the ratio of the value factor divided by the S&P. That means the S&P value ETF divided by the S&P 500. The ratio starts to tick upwards, which actually goes in line with the outperformance of the value factor, and value stocks are heavily weighted inside the Dow Jones Industrial Average and some of them in the Russell 2000. So that actually explained to us since late last week why the Dow Jones Industrial Average and the Russell 2000 is actually outperforming the Nasdaq 100 and some from the other and the SPX as well, because right now the value factor now is leading the fort, driven by the bull steepening of the US Treasury yield curve. All right, and another intermarket dynamics I'd like to share with you all is by looking at very clearly the ratio of the Dow Jones Industrial Average divided by the Nasdaq 100 and the ratio of the Russell 2000 divided by the Nasdaq 100. And previously, this ratio has been pointing downwards. That means indicating to us that the Dow Jones and the Russell is underperforming the Nasdaq 100. Excuse me. Since the start of this Nasdaq 100, most recent major uptrend phase that has been in place since October 2022. So 2022, all right. So right now, but however, the momentum over here. Okay, I don't know why this thing is not showing. Very strange. Okay, let me. Okay, yeah, over here. So the rate of change, the 20-week rolling rate of change, which is the momentum of these two ratio, is showing signs of bullish divergence both for the Dow Jones and the Russell 2000. So indicating to us very clearly that this ratio here is about to turn to the upside. That means rotation back into the Russell 2000 and the Dow Jones Industrial Average, showing medium-term outperformance like what it did previously over here. Okay, from November 2021 all the way up to November 2022. All right, it's close to about a year and so of outperformance of Dow Jones and Russell 2000 against the Nasdaq 100, and this also has been pretty much supported by the bull steepening of the US Treasury yield curve that I showed to you in the previous chart as well. So previously the bull steepening takes shape, okay, over here, okay, during the period of May 2020 to March 2021, and after this bull steepening takes shape, then after a while, what we see over here is that the outperformance of the Dow Jones and the Russell 2000 over the Nasdaq 100, and potentially this particular price action seems to be repeating right now over here going forward, and it hasn't really played out much yet. That means there is still much more room to go. And how do we potentially see much more room to go is the bullish breakout of the US Treasury yield curve above the negative 0.08%. So that could be the potential trigger point to trigger some kind of previous movement that has taken shape in November 2021 to November 2022, where the Dow Jones and the Russell 2000 outperformed the Nasdaq 100 at that point, at that period in time, right? So these are the key intermarket dynamics that I'll share with you all for today in terms of the US stock market performance. Oh yeah, before I go, there's one more intermarket dynamics is related to gold. Okay, so this is the first time I'm sharing for gold. Why? Because it's important. Gold right now has started to break up new high yesterday. Okay, it really cleared above the April and May high of 2,450, and once any asset market breaking new high, a lot of market participants will question the momentum. Can this be more room to go, or do I want to attempt to take a counter trend move or move on the medium term? That is potentially this the end of this bullish trend. So the end of this bullish trend over here, if you look at it over here, this is the daily chart from a medium term perspective. Based on intermarket dynamics, it actually supports a further movement in gold price XAU/USD. Why? Because firstly, look at the dollar index. The dollar index right now has managed to shape a bearish reaction of this descending trend line resistance that I drew over here. Okay, so it seems to me that it's still trapped inside this major symmetrical triangle range configuration on the dollar index. So what by this dollar index means that if this line goes upwards, that means dollar strength. If this line comes down, that means dollar weakness. So and it has an inverse relationship with gold, all right, for sure, because gold is quoted according to dollar. So if the dollar weakness continues to be continues towards the bottom of the range of the symmetrical triangle, it actually supports gold price. Okay, given that it starts to trade in a period of lower high as well over here. So with further potential downside pressure on the US dollar, at least from a medium term perspective, to potentially float down towards the lower limit of this symmetrical triangle range, is supportive of this ongoing medium term and major uptrend in gold price. All right. And also, if you're looking at the trend of gold versus copper, so gold versus copper also starts to turn up as well after hitting the lower limit of a major ascending trend line channel support from 14th of October 2021. So this is a major ascending channel support where the gold copper ratio has managed to turn up and start to shape a series of higher high and looking to break above the previous resistance over here. Okay, that was being hit in March this year. So a further breakout supported by the bounce off from a major ascending channel support. That means gold right now is indicating to us that it's actually outperforming copper, all right, which is also positive for higher gold prices as well going forward. And the next intermarket I want to share with you all is over here will be the US 10-year Treasury yield, but this is the real yield. That means what I did over here is that I get the US 10-year yield minus off the US 10-year break-even rate. That means minus off future inflation expectation. All right. So this gives us a real yield. Okay, why real yield? Because I minus off future inflation expectation, taking off it's a real thing, it's a real, put it as a real interest rate. All right. So why this US Treasury real yield is an important intermarket dynamic towards gold price. Still recall, gold itself, right, is a non-interest income bearing asset. That means anyone who longs gold or hold gold, I will not receive any interest coupon payment, not something like a dividend stock or a bond. All right. So if the US Treasury real yield continue to inch up higher, gold will have a higher opportunity cost of holding. That means it could put downside pressure on gold price. But if this US 10-year Treasury bill continues to inch down much lower, it will lower the opportunity cost of holding gold. So that actually also supports the ongoing bullish medium term and major uptrend phase of gold, XAU/USD. And how do we know that? If I were to plot in gold over here, I overlay gold on this chart over here, it will give us a much more clearer picture, because there's a break of that 2%. It actually also trigger this reason bullish impulsive move in gold. All right, so just give me a hang on a few seconds. Let me open up the gold price chart. Okay, XAU/USD. Okay, OANDA, new plane. Okay, so look at, okay, so what I do is that, okay, I will put this, okay, ignore this, okay. So really recently notice that there's this line in the set, this 2% over here. Okay, so this 2% now has already broken, it's already break down. Okay, so this is no longer green, it's red. Okay, why this 2% is important? Because it also corresponds with the 20-day, 200-day moving average. And previously, this major ascending trend line since the low of 6th of April 2023 that managed to cap the US 10-year Treasury yield from breaking down. All right, previously it hit, it bounced. Then finally it broke down below on 11th of July over here. Right, so notice that even prior before the breakdown, as it starts to shape a series of lower high, we notice that over here, okay, gold price actually end its corrective move, sideways corrective move, and starts to shape that impulsive up move thereafter. And this impulsive up move starts to become more pronounced after the breakdown of that 2% mark over here. So do you notice that if this US 10-year Treasury yield continues to inch much downwards lower, it actually supports the ongoing medium-term and major uptrend phase of gold price. Why? Because lower opportunity cost of holding gold. All right, because gold itself is a non-interest income bearing asset. Okay, I hope that this intermarket dynamics is pretty much clear. Something to actually look out for to actually supports this gold price going forward in terms of their medium term and major uptrend phase. Okay, so with that, that ends today's intermarket dynamics. That's for a medium term horizon. So now let us shift our focus now to the shorter term horizon, the intraday basis, on the intraday technical outlook on the various major cross asset classes, starting with the FX market first. So with that, allow me to actually expand my screen so that you guys could see on the clearer level. All right, the clearer technical level. Okay, good. So let us start off with the FX market first. All right, over here. Where is the FX market? Okay, good. So let us start with the euro dollar. Okay, so no change on the euro dollar. The euro dollar yesterday traded sideways below the 1.090, 1.0925 short-term pivotal resistance level during the US session. It hit the first support level at 1.087, then before bouncing up again. Okay, so no change. This level is still a first support level to watch. Only a breakdown below 1.087 will see much more pronounced intraday bearish counter trend downside move on the euro dollar to retrace the previous minor uptrend phase that has kickstarted from 27th of June all the way up to 16th of July. So that's about 3 weeks of up move. So right now it's doing a bit of retracement of these 3 weeks of prior 3 weeks of up move. So we call them as a minor counter trend decline phase. All right, so a breakdown below 1.087 will actually kind of increase the odds of this minor counter trend decline setback move, or we call it a mild counter trend decline phase, to expose the next support level at 1.0840, which is over here. Okay, only an hourly close above 1.0925 will invalidate today's intraday bearish bias on the euro dollar to see the continuation of the impulsive up move of this ongoing minor counter trend uptrend phase to expose the next near-term resistance at 1.0945, followed by 1.0960. Okay, so that's for the euro dollar. On the sterling dollar, the cable dollar, almost the same as the euro dollar, continues to trade sideways below the 1.30, 1.3010 short-term pivotal resistance level. So right now, as long as this 1.3010 short-term pivotal resistance level holds, we will still maintain that short-term intraday bearish bias over here, looking out for a potential counter trend mean reversion corrective pullback or setback scenario to retrace the previous minor uptrend move that has taken shape from the low of 2nd of July all the way up to 15th of July. So it's more like a retracement. So after this retracement is over, potentially the momentum, the bullish momentum could resume itself again. So support level to watch for this ongoing potential minor counter trend setback or retracement scenario to unfold will be these two near-term supports level at 1.2930 followed by 1.29 figure level. Only a breakdown below 1.29 figure level will open up scope for a deeper corrective pullback or setback retracement scenario to expose the next near-term support at 1.2845. And why do I say that could actually happen if there's a break below 1.29 figure to expose 1.2845? Look at the significant gap so far that it has above the 20-day moving average. All right. Okay, only an hourly close above 1.3010 will invalidate today's intraday bearish bias on the cable to see the continuation of the bullish impulsive upmove sequence within this minor uptrend phase to potentially expose the next near-term resistance at 1.3040/1.3065, which is the top of this minor ascending channel. Above it sees 1.31 figure /1.3155 next. So that's for gold. No, that's for cable. Pardon me, or sterling. Now let us move our focus now to the dollar major against the Asia Pacific currency, starting with the Aussie dollar. So Aussie dollar, since the start of last Friday, we have a bearish bias. So it came down, it did shape that pullback or that counter trend mean reversion decline or setback and hit the support level of 67.20. All right, and now it's also come very close to the lower limit of this minor ascending channel that I drew from the low of 28th of June over here. And what's interesting over here is that the RSI has really shaped a bounce, and this bounce over here has led to a bullish breakout as well, okay, of that former series of lower high or this descending channel. So i.e. what we could see over here is that some form of short-term bullish momentum has started to come back into the Aussie dollar, and with this slew of positive technical element that has arise in the Aussie dollar hourly chart, we will now flip to a bullish bias instead, because it has really made the objective of this potential counter trend setback decline scenario that we have since last Friday. So 67 short-term pivotal support level for today. So as long as this 67 figure level short-term pivotal support holds, we also correspond to the rising 20-day moving average. Notice that it already covered the gap that it has, because there was a big gap over here. The difference between the current price action that was on last Friday and the 20-day moving average, the gap has been covered. That means, i.e., more or less, the mean reversion corrective setback has already played its part. That is being supported by the positive momentum that is being played out on the hourly RSI. So 67 figure short-term pivotal support levels for today flip to a bullish bias on the Aussie dollar. First resistance level to watch 67.60. A breakout of this level, see a revisit of last Thursday minor swing high at 67.90/68.80, 68 figure level next. Only an hourly close below 67 figure level, there is a breakdown of the hourly close below 67 figure level, will invalidate today's intraday bullish bias to see the extension of this minor corrective decline to expose 66.70, which correspond to the rising 50-day moving average. Below it may see a further dip towards the minor swing low of 2nd of July, I think as a next near-term support at 66.40. Okay, that's for the Aussie dollar. Now, moving on, our focus now will be on the dollar yen. So the dollar yen yesterday managed to push up during the Asia session and throughout the US session and the European session and the US session yesterday, it traded sideways, but managed to hold above our predefined first support at 158.20 level. Okay, it didn't break below this level. So still no change, still using our very key short-term pivotal support level that managed to help the previous sell-off since 11th of July, 157.45. So as long as 157.45 short-term pivotal support holds, we still look out for another leg of this minor corrective rebound scenario to play out. Next near-term resistance to watch out for on the dollar yen will be at 159.45. Above it exposes 159.90/160.30, which will correspond to the the 20-day moving average acting as a resistance, and as well as the Fibo retracement as well as a resistance at the golden ratio of 61.8%. Owning an hourly close below 157.45 will invalidate today's intraday bullish bias for that counter trend rebound to play out to kickstart another round of impulsive now down move for the next leg of the minor downtrend phase to actually unfold. In first step, next near-term support level to watch will be at 156.65, followed by 156 figure level next. All right, over here, okay, which is the minor swing low of 12th of June. So that sum up the short-term intraday technical outlook for the major FX pairs. So now let us focus now on the major stock indices, starting with the Asia Pacific indices with the Hong Kong 33 or the Hang Seng Index. So the Hang Seng Index yesterday, we do have a lower limit of the short-term pivotal support at 17,660, with price action indeed held out to it this Asia session this morning, okay, as it tried to sell off and managed to find some support over here. And what's interesting over here is that the hourly RSI has started to shape a higher low. Okay, so there's some form of bullish divergence that has been fleshed out on the hourly RSI, indicating to us that this minor sell off here is losing its downside momentum. So net overall still no change. 17,660 short-term pivotal support level. First resistance level to watch will be at 17,900, which is the 20-day moving average, so acting as a resistance. Only a clear breakout of this 17,900 level will see a much more pronounced recovery, at least on a short term to intraday basis, to expose the next near-term resistance at 18,225 in the first step. All right, but however, if we see an hourly breakdown with an hourly close below 17,660, then this intraday bullish bias will be invalidated to see an extension of this decline to retest the minor swing low of 9th of July and 10th of July that is acting as a support at 17,430 / 7,360. A breakdown below this level will see a further push down to actually test the key medium-term pivotal resistance zone, support zone, pardon me, at 17,200 / 17,110, which also confluence with the 200-day moving average as well. Now, focus on will be the Japan 225 over here. So the Japan 225 continues to trade sideways, holding above the short-term pivotal support level that we highlighted yesterday at 41,090. So over here, it tested this level again while we are speaking, but there's some form of support that's being formed as the hourly candle starts to form a tail as well, okay, over here. So this is a short-term pivotal support that we got to continue to monitor, or the Japan 225 or the Nikkei 225. So as long as this level holds, 41,090 still maintain that short-term intraday bullish bias. First resistance to watch, you got to actually, the hurdle you got to clear above will be at 41,820. Above this level sees 42,140 next. However, if we start to say hourly close below 41,090, then the short-term intraday bullish bias will be invalidated for the Japan 225 to see another leg of minor corrective decline phase unfolding to test the next near-term support level at 40,800, followed by 40,250, which corresponds to the rising 20-day moving average. Okay, so now with that, let us focus now on the European stock index, which is the German 30 or the German DAX. So the German DAX yesterday indeed flowed down and hit the first support level at 18,500 / 18,450 as it continues to actually oscillate within this minor expanding wedge configuration, the one that I highlighted in purple line, that is in place since the low of 14th of June over here. So with that, potentially, given that it's still trading within this expanding wedge, it hit the middle part of this expanding wedge. With that, I was using a very tighter key short-term pivotal resistance for today at 18,700 level. Okay, so if you do the Fibo retracement of the decline so far since hitting off the expanding wedge resistance level on last Friday, is also correspond closely to the golden ratio of 61.8%. So as long as 18,700 short-term pivotal resistance holds on the German DAX or the German 30, we'll still maintain that short-term intraday bearish bias. A breakdown below 18,450 may expose the minor swing low area of 9th of July and 10th of July that is acting as a support at 18,235, which is also the lower limit of this expanding wedge as well. However, if we start to see a breakout with hourly close above 18,700, that will invalidate today's bearish bias to see a further squeeze up to retest the upper limit of the expanding wedge, now coming to excuse me, now coming to act as a resistance at 18,845. Okay, so that's for the German 30 index. Now, starting with the major US stock indices, the US Wall Street 30. So the US Wall Street 30 continue to squeeze upwards and hit our resistance level at 40,860. Okay, so this level has been met. And if you look at the price move yesterday, is rather steep on the intraday basis. Okay, and the hourly RSI also comes very close to a grossly overbought level as well. Okay, over here. Okay, so if you look at it, so far this is the high. Okay, it's coming very close to a grossly overbought level. So with that, there's actually a risk of a pullback that's taking shape. And also, where does the current price action ends? The current price action ends with a cluster of FIBO extension level, okay, 2.618. Okay, from the low of 30th of May, 1.618 from the low of 14th of June, and 2.618 from the low of 28th of June, all conferencing at around the 4185 level, 41185 level, pardon me. And this 41185 level also corresponds graphically with the upper boundary of this medium-term ascending channel that I drew from the low of 19th of April. So given the fact that graphically, FIBO extension level, extreme overbought hourly RSI reading, or potentially give us a scenario of a minor counter trend setback scenario to unfold, at least on an intraday basis. All right, so with that, I will flip to a bearish bias for this potential intraday counter trend pullback or setback scenario to unfold using 41,185 as my short-term pivotal resistance level. Support level to watch in this potential counter trend setback or pullback scenario will be at 40,390. A breakdown below 40,390 exposes 40,185, 40,060. And if you do the FIBO retracement over here, okay, it also corresponds to the 38% and the 50% FIBO retracement, which is a typical wave 4 corrective target. So why do I say wave 4? Put it in a way that this is a minor wave 1, wave 2. This steep move here is the wave 3. Then right now it's unfolding a potential wave 4 in terms of the yield wave perspective. All right. However, only an hourly close above 41,185 short-term pivotal resistance that we have for today on the US Wall Street 30 or the Dow Jones Industrial Average will invalidate this intraday bearish bias to see the continuation of the impulsive up move to expose the next near-term resistance at 41,500, followed by 41,900 next. Okay, moving on will be the Nasdaq 100. So over here, Nasdaq 100 continues to trade sideways, so no change as it continues to actually hover sideways above the rising 20-day moving average. So still using 20,060 level as my short-term pivotal support level, still maintain that short-term intraday bullish outlook on the Nasdaq 100. First resistance to watch will be the current all-time high area at 20,620/20,710. Above this level exposes the next near-term resistance at 20,900. Only hourly close with a breakdown below 20,060 level will unfold a potential minor corrective setback scenario or pullback scenario for the Nasdaq 100 to see the next near-term support level coming near-term support level coming in at 19,660, followed by 19,520, which will correspond very closely to the rising 50-day moving average, and as well as the medium-term ascending trend line drawn from the low of 19th of April 2024 low. All right, so that sum up the intraday technical outlook on the major stock indices. So now shift our focus to the commodities. Gold XAU/USD. So for gold XAU/USD, it really hit the first we call it a resistance level, which is at 2,473 that we highlighted yesterday. So this is a very strong impulsive wave 3 move or for gold XAU/USD in terms of the elliott waves perspective. Hourly RSI has really hit the overbought level over here, so potentially there could be a pullback taking shape over here. So what we could see over here, this is considered as a minor bullish acceleration move that is taking shape in gold XAU/USD, given yesterday breakout of the minor ascending channel resistance over here, this green line over here. So with that, I'll be using this green line here. Now it's a dotted line, which is it's a pullback support level, which corresponds closely with the congestion area here of 16th of June and as well as 15th of July. All right, over here. And if you do the Fibo retracement of this move up over here, it will correspond to the 38% as well, which is a potential wave 4 target as well. All right, over here. So right now, given the fact that it could be a wave 4 that is unfolding, okay, so wave 4 38.2% is pretty much standardized. No bearish divergence that's being expressed over here, so I do not expect the minor pullback to be much so deep. So 2,433, so as long as this minor pullback managed to hold at the 2,433 short-term pivotal support level for gold XAU/USD, we'll still maintain that short-term intraday bullish bias for gold. Next resistance level to watch will be at the 1.618 Fibo extension level, 2,510, followed by 2,532. Only an hourly close below 2,433 will invalidate today's intraday bullish bias to see a much more deeper minor corrective decline play out within its short and medium term uptrend phase. Why the short and medium term uptrend phase is still intact? Because it's still holding above the rising 20 and the 50-day moving average to expose the next near term support level at 2,417, followed by 2,393. That means a kind of a reintegration back into the lower limit of this minor ascending channel again. Okay, so that's for gold XAU/USD. Now, moving on will be the West Texas crude oil. So West Texas crude oil, we have a bearish bias since the start of this week. The bearish bias has been hit our support level at 80.56 level. So with that, we start to see the up move in the hourly RSI as well. So potentially there could be a minor bounce taking shape for West Texas oil, also holding above the rising 50-day moving average as well. So using 79.90 as my short-term pivotal support level, slightly below the first support of 80.56 that has been made yesterday. So as long as 79.90 short-term pivotal support holds for today, we'll flip to a short-term intraday bullish bias for West Texas oil. First resistance level to watch 81.86, followed by 82.50 level. All right, so this 82.50 level also correspond to the rising 50-day moving average. No, the 20-day moving average, pardon me, a bit of tongue twisting, the 20-day moving average that's also acting as a resistance. Congestion area of 15th of July, and if you do the Fibo retracement of that last push down from last Friday all the way up down to yesterday's intraday low over here. Okay, let me remove it. Okay, it's a bit slower. Oops, can't come up. Okay, let me do again. I want to show you it coincides with a key Fibo retracement level, okay, which is a golden ratio at 61.8%. However, if you see an hourly close below 79.90, then this intraday bullish bias will be invalidated to see the continuation of this corrective down move to test the 20-day, 200-day moving average, I think as a support level at 79.10. A breakdown below it sees another much more deeper corrective down move to expose the next near-term support level at 77.90, which is the minor swing low area of 13th of June and 17th of June. Okay, that's for West Texas oil, which also sum up our intraday technical outlook on the major cross asset classes. So before we go, let's take a look at the economic calendar to share with you what are the key data to look out for today. So over here, today what we have over here at 2 p.m. we have the UK inflation rate. We could have a potential impact on the sterling dollar, as well as any sterling cross pair currency. It will be out at 2 p.m. Singapore time. And followed by that, we do have a finalized Eurozone inflation rate. So that shouldn't be a big surprise because 2 weeks ago, they released the preliminary figure. So more or less, it will be the same at about 2.6% year on year. So that will be out at 5 p.m. Singapore time. And followed by that, over the US session, we do have rather a quiet session, some housing data to take note of. They call it the housing stats for June, out at 8:30 p.m. Singapore time. And we do have one Federal Reserve official speaking, Fed banking, at 9 p.m. Singapore time. Then at 9:35 p.m. Singapore time, Fed Waller will be speaking. And we have the weekly USEIE weekly crude oil stockpile change, so that could impact the WTI crude oil prices at 10:30 p.m. Singapore time. All right. So thereafter, a rather quiet US session. Okay, so with that, that sum up today's intraday, that sum up today's daily dose of market insights. I'm Kelvin here signing off. So I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.